And first of all, a very big thanks to our sponsor for this evening, Markham Associates. Steve Brown, who's going to follow me here at the podium, is the COO of Markham. And so they very generously sponsored this event. And just for everybody's information, the committee, the event always welcomes sponsorship. So if anybody has any interest, please leave your name at the door. So,
Mr. Mark.
I'm going to say, I guess, firstly, just a brief thing about myself. I'm an architect, and I've been practicing here in Boston for almost 30 years. And throughout my career here, I've seen a number of waves of development, both the ups and downs. And we've seen the good and the bad. And it's been, when it's good, it's great, and the city is booming, and when it's bad, it's awful. And professionally speaking, as an architect, I can tell you we ride those waves. So it's been good and bad. And I've seen worked on a lot of range of projects, commercial, residential, renovation. So I've seen it all, and it's certainly very, very interesting personally to me. So that's just a brief mention about my background and my involvement in this committee. Now, Markham, I wanted to just say a few words about Steve's company. Markham is one of the largest independent public accounting companies in the country. They're ranked number 15 nationally with over 1,300 professionals. Excuse me, I'm reading this. I didn't have time to memorize all this, and with 160 partners and 22 offices throughout the country. So, at Grand Cayman and China. So Markham is an international company. They are headquarters in New York City, and they provide a comprehensive range of professional services from accounting to advisory, technology solutions, wealth management, executive and professional recruiting. So they're a full-service kind of business consulting company. And Steve, who will follow me here, will say a few more words about Markham. So with that, I'm going to ask Steve to come up here and take the podium. Thank you, Steve.
Again, thank you all for being here, and thanks to this fabulous panel who's going to work with us tonight. So I'm here in two capacities. One is as a member of the steering committee, an alum, and a trustee. I can tell you it's just great to see this kind of turnout. We've been doing this now for 10 years, and the reason it's gone on for 10 years is because you all come out to support this, and it's really fabulous. So thank you all very much. I'm also here proudly to represent my firm, Markham LLP. We used to be Braver locally, and some of you may remember that name. And we merged into Markham in January. Markham, we were a large regional firm. Markham is a large national firm. We sought a partner for 2 years and found the right one. So, and they're very supportive of Bates. They are not only supporting this event this evening, but they're also supporting the football golf event, which is on June 23rd, and there's one foursome left. So if anyone's a golfer, Sue Harriman is here, and she'll be happy to go. So here with me tonight, supporting the Bates Business Network are some of my partners. Chris Stevens, who's our REIT expert, Dennis Palecchia, who's our real estate partnership expert, and Walter Jackson, who is a director in our advisory services. So once again, thanks so much for being here. We appreciate it, and I'm going to turn it back to DP. Thank you.
By the way, firstly, I wanted to mention that Steve is not only a member of the steering committee, but a Bates trustee as well. So we thank him for his efforts on behalf of Bates too. So tonight's event is, we're going to be talking about real estate tonight, and we have the Bates real estate team here. We're led tonight by David Campbell, who was previously with Codman Real Estate, and he's now with Cassidy Turley. This is round 2 for David, because we held a similar event back in 2007, and David also moderated the event back in 2007. So we're going to hear an interesting perspective from him. He's seen the cycles of real estate here, and I'm sure that'll be a very interesting topic of conversation. So we're also joined tonight by Tom Darcy, who's class of 83, so around there, 85-ish, parent of a Bates student or a future Bates student.
Exactly.
And he's with American Capital Real Estate. Close. American Realty Capital. Healthcare Trust. He's the CEO of American Realty Capital Healthcare Trust. So, and he'll say a few more words about his organization. And we're also joined by Scott Freeman, who is also class in the 80s era, and also a parent of a current Bates student and a future Bates student. Right. So we are representing Bates very well this evening. And Scott is the principal of Colony Real Estate Partners, which is based here in Boston, and also a significant firm in the city. So with that, I'm going to turn it over to David, who will take it over. Thank you.
Well, it's really, welcome again. It's really great to see the turnout. And I think one of the special things about Bates College is really to get to know people from all the different classes. You know, I've been lucky enough to know Steve Brown now for 15 years or so, and the class of '69. I know people who just graduated in the past couple of years. Dan Hines is in here. He's in the real estate industry as well. And it's great that you can come together like this and have these events. A lot of colleges can't do this. People go off on different ways, and it's really special. It's also special for me to be on the same panel with Tom Darcy, Scott Freeman, not only really respected real estate professionals, but we're also playing the same football team together for a number of years. And just a quick story before we get It's clean, believe me, it's clean. I know we're on the air, so. But I remember walking. I was in class of '82, and I remember coming up we got there a week early to football camp before the rest of the school came in, and it was the first meeting, and everybody meet in the gym, 2 o'clock in the afternoon, and I was thinking, hey, I just came out of senior year of Marblehead High. I was a captain. I was like, hey, this is great. This is going to be a lot of fun. I remember walking into the locker room and seeing guys like Tom Darcy, 6'2", 225. I don't think he'd shaved in 2 months. And Scotty Freeman. I don't want to throw your weight out there.
I was 255.
Okay. I was pushing 180 at the time. And I was a receiver, and Tom was a linebacker, and I was just immediately looking ahead, going for a pass. He's coming at me. It was just kind of one of those. So it's great memories. But to see us now up on a panel here, talking professionally going back from those days, it's kind of special. So I just wanted to get that out. So commercial real estate, the state of commercial real estate. It's a broad subject, and it's really. Real estate's something that we're all pseudo-experts at, right? We all think we know something about it, and we all either rent an apartment, we live in a house, we go to an office every day, we probably shop on the weekends. You might go to the Home Depot, which is High Bay Warehouse. You might have stayed in a hotel in the last month. It's a vast profession and area of expertise. And to pull it all into perspective is kind of difficult, but it's visible, it's touchable, and it's usable. And we're in and out all day, seeing it, feeling it, living it. But it's also very adaptable. And what I think is happening today is it's conforming to a major generational change. We're seeing it. We're living differently. We're working differently. We're playing differently. Everybody sees that live, work, play. It's out there. It's very popular today. For the younger guys here, it's hashtag LWP. if you can't really understand what I'm talking about. But it's really, when you think about it, the way we live, they're building apartments 400 square feet right now. Just couldn't even imagine that growing up, living in that small space. We're working differently. People are telecommuting, meaning, hey, don't come in Monday or Friday. Back in our day, I don't want to speak for these guys, but I'd be in big trouble if I didn't have to go to work Monday or Friday. You know, hoteling, it's people sitting at benches today. It's really, it's changed. It's just a huge phenomenon. People are learning how to work differently, work away from the office, work more efficiently, and it is go, go, go. You know, we need that information. We need it quickly. So to give you a local perspective, and I think to tie this all together.
Scott, I get to talk about it. I'm just curious.
I thought I'd segue into this. This is a good thing.
Scott was wondering, I was fine.
So let me pull it all together right now. I'm very anxious. I can't wait to hear what he has to say. So really, to pull it all together, you'd really have to have been living in a cave under a rock or spending too much time in Lewiston, Maine to not notice the amount of cranes that are dotting the Boston skyline right now. And this is really, it's a competition between retail, residential, commercial, hotel, medical. You can go anywhere from Longwood to Fenway to the Back Bay. Liberty Mutual just finished their headquarters. Another building's going to start at 880 Boylston Street this summer. Into the downtown crossing area, the big hole that's been sitting there for 2 years. Arnold Worldwide's going there, retail's going, residential's going there. It's really transforming. You've got Converse and North Station. The Boston Garden's going to be redone. You know, and they even have a new zone, the Ink Block. It's never heard of it before, but now there it is, the Boston Herald building. It's being developed, which all leads us to the seaport, where this is going to segue into the expertise of our panelists here.
Really?
It's really a microcosm of everything that's happening today. You've had 4 residential developments, 2 that are finished, 2 more that are going up right now. You have a biotech firm in 1 million square feet, Vertex Pharmaceuticals. You have a building that's going up for PricewaterhouseCoopers, who are going to be basically, they're going to have 20% more people in 12% less space. You have another building that's going to start from Goodwin Procter, major downtown law firm. You've got a hotel going up right now. You have a convention center, you have retail, and there's more to come out there. So realistically, guys, is it interest rates? Is it the functional obsolescence of existing buildings? Is it foreign capital? What's making the commercial real estate home today? Tom?
Well, first of all, thank you. It's great to be here. It's especially great to be at a Bates event. You know, I can't tell you how much I feel for Bates. All my whole life, graduated in 1983, I think. It's just been a lifelong experience of love of a college, so it's great to be with Bates friends. The other thing I was thinking of is Steve did a great job putting the panel together, really creating a diverse panel between the 3 of us. One of us has spent way more time with the goose. One of us has spent way more time at the library, and one who kind of split his time in between. I'm not going to point to the person spending way more time with the goose.
What's the goose look like inside?
So my business is more, it's driven by all those factors, but I'm in the healthcare real estate business. So we invest in medical office buildings, seniors housing, as well as hospital assets. So it's kind of a particular niche in the broad universe of commercial real estate. Commercial real estate, basically is a kind of a $9 trillion business, so investable real estate. And healthcare is about $1 trillion of that $9 trillion. And so what's really interesting about healthcare right now is the macro demographic factors that are driving our business. So real estate's a simple business, which is one of the reasons why I'm in it, right? And it really is occupancy and physical space. Kind of simple, great for liberal arts education. And the question becomes, what drives the demand for that occupancy and physical space? So if you're a CBD downtown office building, it's service jobs, and it's the growth of the local economy. If you're in industrial, it's industrial output, and expansion, and transportation. Healthcare is driven by just the demographic wave that's affecting our country. So how many baby boomers do we have in the crowd? There's 80 million of us. 10,000 of us turn 65 every day and will for the next 20 years. Fastest growing age cohort in the country today? Who wants to take a guess? Plus 85. So Americans that are plus 85 years old are growing 3 times faster than the entire country. So just think about that for a second. 80 million baby boomers, living longer, and that's driving the spend in healthcare, right? So whether you're a Republican or Democrat, when those guys are beating themselves over the heads down in Washington, it's really all about that, right? If you're 65 years or older, you'll spend 80% more on healthcare than you will if you're 45 to 64. 80%. So think about it. 80 million baby boomers, 10,000 every day, spending more, 80% more than the entire population as a whole. So that's what's driving the demand for healthcare goes. It's interesting. So we're investing in medical office buildings. We're investing a lot in seniors housing. Right? My dad's 87, my mom's 85. God bless them. Right? But for 85-year-olds, it's estimated that today, if you're 85 years old, 1 out of 3 Americans will have a level of dementia that requires care. Interestingly, over 2/3 are women. So we're investing a lot in memory care as well. So the point being that commercial real estate is a broad asset category. There's a lot of different niches within that asset category. We happen to focus in on one which we think is particularly attractive currently. We do it in a public format. So my company's listed on the NASDAQ exchange with the symbol HCT. And we think it's a good business and will continue to be a good business. And I can tell you that I wouldn't be whatever modicum of success that I've had if it hadn't been for Bates and the whole grounding that Bates would provide. So you can talk about interest rate, exchange rates.
I majored in applied science, not economics, so I appreciate the chance to be here as well. We're a highly connected Bates family. My wife and I both graduated from Bates, and I think the true statistic is 13% of the graduates that marry other Bates graduates. Our son is a sophomore, and our next son was just admitted, so he'll be a freshman next year. So we're pretty all in for Bates. And actually, my first job, I had gone through an internship program here in Boston at what was then called the Bank of Boston, and I had a job offer my junior year, so I was somewhat relaxed during my senior year. And unexpectedly, a Bates graduate, a guy named Ted Ward, from the class of '61, I think, came to Bates and interviewed for a job. He had taken over a failing savings and loan in Miami, and this was 1985, which, if you recall that time, was the Wild West of the financial crisis in the savings and loan business, which we'll come back to a comment I'm going to make in a moment, because there are a series of these sort of crises that come, and particularly they affect commercial real estate. Usually commercial real estate is the terrible drunk that leads us into a crisis. This time we worked that cause of the crisis. But at the time, I decided to go to work for this small savings and loan, and Ted Ward, who was this Bates guy, hired 4 Bates people, none of whom expected to go and work for the savings and loan. We had some very unique experiences that around the time that the Federal Home Loan Bank decided to take over that savings and loan, we all decided to go back to business school. And actually, Ed Wilson was the dean of the Kellogg Business School. He was a Bates grad, and he also made an introduction to that school for me. So I'm all in for Bates. I think David and Tom gave some specific examples. I think I'd like to sort of pull back and just talk generally a little bit about the commercial real estate business. Our firm is a real estate private equity firm. We're owned by a couple of guys here in Boston in partnership with a very large international firm called Colony Capital. And so we have, I think, a perspective both in terms of institutional investors globally and also investments globally. We have a series of commingled funds. They happen to be structured as private REITs primarily for tax reasons for our tax-exempt investors. But these funds have been looking at broad, diverse portfolios around the country. We're in 22 metropolitan areas. We purchased around $4.5 billion of assets, mostly relatively basic B, kind of B+, A-, not the towers, not the shiniest product off the developers' pipelines. When I started in the business, it was at the time of the savings and loan crisis, and the commercial real estate business had collapsed. The mortgage REITs had collapsed, and it created great opportunity in 1989, 1991, a terrible time in the commercial real estate business. That was the time to get to buy. We went through a cycle. We had a series of these cycles. We had the currency crisis in 2000. The most recent thing that we've just gone through, which was probably the worst experience in the commercial real estate market since the Depression, as it was for the broader economy, created all kinds of incredible opportunity, but it really laid bare some of the underwriting excesses that institutional investors got pulled into. Again, when I started in 1985, institutional investors didn't really look at real estate as an asset class. Real estate was among there were stock and bonds, right? And real estate was an other category. Then alternative investments became a category, but real estate was one of a series of alternative investments. Today, as the market has matured, as institutional capital has matured, most of the large investors, and some of our largest investors are some of the larger investors in global real estate, all global investment markets, they've gotten specific allocations to real estate, 5, 6, 7% of gross assets. Some as high as 10, or you can even read of Texas Teachers, a giant in our business, has just made a $1 billion commitment that's going to bring them to 13%. So it's become a very large asset class. What that means is in good economic times as we have right now, there's an awful lot of capital that's chasing deals. And in 2007, that market pulled back dramatically, capital pulled back dramatically, cap rates went way up, the prices of these assets went way down, and it was a great buying time. Today, there's a tremendous amount of capital chasing deals, particularly core deals the most stable deals, highest quality in the primary markets. And so that capital, as the institutional investors have looked to diversify their capital sources, they have sought to expand beyond the straight core, straight major market deal flow that has been most typical for institutional investors. And so in our business, we have a series of what in the industry is known as value-added funds. These are not purely stable, not the highest quality, but also not empty or development or gut rehab kind of properties, but the properties in the middle where there's some reason why, if we're smart enough, and sometimes we are and sometimes we're not, if we're smart enough, we can remanufacture that product into something a little bit better than the core that we hope it would be if we can buy it stabilized. So those investors are driving cap rates, and cap rates have gotten to the point, if you think back to 2007, which was probably the peak, maybe it was the beginning of 2008, cap rates had gone down on core properties to 6.5%. So the return that you get on the first year's income was 6.5%. Debt was quite a bit higher. Today, with debt at 3.5%, and you can get interest only for 5 years on your debt, if you think about it this way, you can buy, if you put 50% debt at 3.5% interest, and you buy something on a 5 at 50% debt, you're at 6.5% return to your equity. At 6.5% return to your equity, what in your institutional portfolio can you generate? Think about the bond portfolio. Think about bonds that you could invest in today. There's not much that you can buy that has a 6.5% current return. So an awful lot of institutional capital is piling into core properties, institutional quality properties. Those cap rates have come down dramatically, and it's causing institutional investors to look a little further afield. Now we're moving back into value-added properties and even into opportunistic properties. The development cycle is beginning to ramp up again. And so I'm not forecasting something similar to what happened in 2007. I think that's not going to happen. But real estate's a cyclical business, and we're going through a time, as David mentioned, there's all cranes are in the air, there's all kinds of expansions going on. There's a lot of pent-up demand that happened since the last few years have been so difficult in 2009, 10, 11. That capital is chasing down cap rates, up prices, and so the opportunities are, I think, less obvious. And there are institutional investors that have no choice. They have to get a load out, and they're going to buy whatever the return is of their efficient frontier, 5% or 6% or whatever the allocation is. But today, to be a little bit more clever and find assets that for one reason or another are not stabilized, or are not core at the moment, but can be turned into core in the not so distant future is what we think is the opportunity today. I may make one other comment about underwriting. So in response to this, underwriters like us and everybody in their asset classes are responding by being more aggressive, right? In 2005 and 6, we were assuming, trees don't grow to the sky, but rental rate growth was going straight line up. Free rent had been reduced to 0. Tenant improvement allowances had been assumed to be minimal. Other inducements had assumed to be minimal. Today, and then the debt decline came, right? Free rent became permanent. No rental rate growth. Big concessions. Tenant improvements that were $25 a foot, $50 a foot, $75 a foot. Now, in the last 2 or 3 years, as the market has recovered, underwriters like us are saying, well, maybe we can have some rental rate growth. I was talking about a property in Atlanta today. Atlanta's a developer market. In my 25 years, the price of properties in Atlanta was $160 for an A- office building in Buckhead. Today it's $160 for an A- building in Buckhead. They don't grow. The rental rates don't grow. It's just additional development. So, but guys like us respond to the tight capital markets and the need to put money into investments by increasing their aggressiveness. And the challenge for guys like us in the real estate business is to respond to the reality of the market, but not to get so far ahead of ourselves, not to allow ourselves to get carried down the stream, as so many underwriters, and we did too, in 2007 and 8, thinking that trees do grow to the sky. So we're trying to, at the same time that we're trying to respond to our investors' demand for these products, we're trying to be real and remind ourselves what happened in 2007 and 8, and what happened in 2000, and what happened in 1989, 1991. And if you go back, you'll see cycles that went back 5 years or 10 years at a time. It's highly cyclical business.
Scott was talking a lot about the institutional world. I've been in the real estate business for 30 years. 28 of those have been with the institutions. Interestingly, the last 2 years with American Realty Capital has been raising money for retail investors. It's kind of interesting. So what's happened is, if you go into Bank of America today, what's the CD rate, right? 0.4%. So one of the big issues that's affecting America, especially older Americans, is no yield in the market. And that's coupled with the fact that people are still freaked by the financial storm of 2008, 2009, 2010. Maybe not people in this room, but I can tell if you go across middle America, they still remember when they were lying in bed with their significant other and it was dropping every day. Should we sell? Should we stay? Should we stick? It had an incredible impact on the country as a whole and psyche, and it's just kind of working its way through. And so then if you believe that the market's overly volatile and you're looking for yield, but then you can't find yield because there really is no yield. 10-year treasury is under 3%, CD rates are under 4%. Then you start to look around, what's a yield vehicle that the retail investor can get a consistent, safe, non-correlated yield? And real estate's a great opportunity to do that, but real estate is traditionally been controlled by guys like Scott, and all the folks that are within 5 blocks of the 4 or 5 park in New York. So what American Realty does is we have a product called non-traded REIT. It's a publicly registered, non-listed product. We pay a 6.5% dividend yield. We sell it through a large array of broker dealers. So, for instance, this is how we built our company before we took it public. So we had 68,000 registered reps that were selling our product, 300 companies, to retail investors. The average investment in this company was about $30,000. And these were moms and dads and grandfathers and grandmothers that were putting their trust in us that we could be smart and fiduciaries for that capital, provide them a nice steady return, buy the properties that Scott was talking about, and then create liquidity for the investors. And so in that format, we raised $2 billion of equity in about a year and a half. We have another fund right now. We'll raise another $1.5 billion of equity in a year and a half or so. And it's responding to a need, right? The need is the fact that there's just a desperate need for kind of a fixed income and yield in the marketplace today. The challenge with it is, as Scott mentioned, when capital begins to outpace the demand of products, what happens? Even I know, by one class of economics, prices have a tendency to decline. That's what we're seeing in the market. Back to David, I'm sorry.
Well, I do have a question for you, Tom. So you are a public company. Should we invest in the stock?
Absolutely. Do you want to ask what the stock was?
I think that's right. It's at everybody's tongue right now. And Scott, you're talking a lot about, these are great points because when you're looking at cap rates, it's really a market. You go back 10 years ago and people are buying buildings at 9, 10 caps. Now you're down into the 5.5, 5 caps. And the only reason that's possible is because of these interest rates being so low. Give us a little snapshot into the future. Where do things start going south? When does it go bad? Is there too much going on right now? Just going back to the whole scene in Boston, I mean, has anybody seen this many cranes in any city anywhere other than maybe Saudi Arabia? I don't know.
San Francisco.
But really, it's never been seen before. And so, is there too much happening?
This is an active cycle in Boston, but I wouldn't say it's never been seen before. Developers develop. When money's available, they develop. I think whenever they say it's different this time, worry, because it's never different this time. It's not different this time, and this is a cyclical business. We're going to have a cyclical downturn. There is some discipline left in the system, right? So, if you're a developer, I was looking at an industrial building, it happens industrially in Chicago. The developer today still needs 30% equity. The lender's going to require that there be 1.35 coverage. There's going to be some gut check that still has to go, which wasn't the case in 2006 and 2007. You had lenders that were lending 100%, no equity. And it was interest only for 5 years or 10 years. We have not seen that. There's still real equity that's required. There's still coverage that's required. The CMBS market, which is back, is nowhere near at the crescendo that it was in 2007, but it is headed in that direction. I think as long as interest rates remain low and inflation remains low, and the premium that you can get, as Tom described, and all the moms and pops and all the institutional investors, they are different sizes and different views, but they want the same thing. They're looking for alternatives to particularly bonds, but other yielding assets. As long as they can get a gap, and it's generally been, if you look over a long period of time, if you can get 300 basis points over inflation, you were pretty happy with an illiquid investment like real estate. There were investors that required 5, but even at 500 basis points. So today, inflation is nothing, right? There's very little inflation. If you can get an overall return in IRR, that's a 6. You've made a 500 basis point premium to inflation. That's why institutional investors have chased down cap rates. They're willing to accept IRRs that are 6%. David is right. When I started in the business, if you had less than a 10% return, it was like a rule of thumb. 10 cap, boom, 10 times the income. That's the value of the property. That hasn't been the case for, and it may be permanently different, but certainly until inflation and interest rates are meaningfully higher, we're going to continue along this relatively happy path, knowing that it is going to go higher, and we are going to have a cyclical downturn. The governors are there, but the pressure is there to continue to increase values.
One of the things that's interesting about the healthcare business, and actually that $1 trillion market, it's remarkable how fragmented it is. So that, take $1 trillion, that's $1 trillion of medical office buildings, hospitals, acute care hospitals, senior housing assets, skilled nursing facilities, inpatient rehab, kind of the entire continuum of healthcare. The REITs themselves, which I would argue are the most efficient owners of real estate, right? We get access to every equity, we have tax efficient, we only pay only tax at the shareholder level. REITs own about 9% of that real estate. And the person I'm sitting here, if I ever get invited back 5 years from now, that 9% will be 18%, and the 18% will be 30%. So what's happened now with the Affordable Care Act, and what's interesting, we travel around the country, we lived with Romney Care for a few years, and what's happening in Massachusetts is happening in the balance of the country, which is, right, these big acute care hospitals all of a sudden extending their reach into the community. So I'm sure that in your communities you're starting to see these very attractive outpatient facilities getting built. And oh, by the way, you never see a doctor anymore, so, right? Dr. Jane, I don't see them anymore. It's nurse practitioners, right? It's all about trying to drive healthcare to the lowest cost setting. The most expensive place to provide healthcare are these big acute care hospitals. And it's interesting as you travel around the country. So you think about a hospital, it's a fixed asset. They built this hospital 20 years ago. And boy, communities change in 20 years, right? The demographics change. The demographics are all about the payer mix. Who's paying the bills for these hospitals? In lower demographic areas, the payer mix is Medicaid, which is obviously and it's a net loss on every dollar invested. So the healthcare in the country is radically changing through the Affordable Care Act. And it's changing every day. And these regional healthcare systems are beginning to grow up. And now they need the capital, because all of a sudden they're buying the physician groups, right? And so physicians, 5 years ago, 75% of all physicians were independent businessmen. Today that's about 35% drop. You just simply can't be an independent businessman as a doctor. I remember growing up where the doctor had a big house and a car, and he was a team member of the community. Now they're employees of this healthcare system simply because all of these networks have been formed, and narrow networks. It's amazing what's happening in healthcare across the country. It has a direct impact on my business, and we're trying to figure out the landscape of who the winners and losers in this radical shift of 20% of the entire economy in a very finite period.
Tom is right about the public efficiency too. Guys like us, and our partner Colony Capital has founded a publicly traded REIT and has raised $3 billion in the last year and a half. It was originally designed to do mortgage investments, but it's now become a full real estate investment platform. Blackstone's done it. There are several firms, because it's an evergreen source of capital. And going around every 2 years to raise a fund is a drag. And that capital is much more picky today and has been through a lot. And so there are more and more firms that are going
It comes with a cost, right? Just as an example, last night we have a kind of a sister company, American Realty Capital Properties, and they invest in net lease properties, CBSs. So last night they raised $1.7 billion overnight in investment. And just think about that. Bank of America, Merrill Lynch, JP Morgan came in there, and Fidelity, and Wellington, SCB. So overnight they raised 1.7, you don't fill the price, but there was 1.7 billion of equity overnight. Just speaks to kind of the efficiency of the capital, the efficiency of the capital markets, the changing in the banking system as well, changing regs, how much pressure there is on the banks now to generate fee income through loans, and through underwriting. So it's it's interesting when you think about the changing landscape and the effect of regulatory change in Washington, how it reverberates down through, works its way into the capital markets, and manifests itself kind of every day in our everyday business.
Regulatory capital ratios, the banks and the insurance companies can't own real estate. Or the real estate they own counts so heavily against the capital base that it's almost an impossible penalty to overcome given the return alternatives. So public capital is coming in to replace a lot of that. The other thing we haven't talked about is tremendous foreign capital coming in. The largest investor in our series of funds is a sovereign wealth fund from Asia. Money seeking safe haven from the Middle East, from Asia, from other parts of the world are pouring into the United States. If you think about it, the capital cost in the Middle East is it's near zero. The money that's coming in, primarily through petrodollars, is being, not only are they getting the sovereign wealth fund, sort of public information, right? The Abu Dhabi Investment Authority has $200 billion that's coming in every year. It's immense. They can't find an outlet for this kind of money. So that they're looking for, and particularly they want hard assets because there's security in hard assets. And so real estate is the most available hard asset in the globe. And so more and more foreign capital is coming in. We foolishly in the United States have a rule, again, that penalizes sovereign wealth funds, all foreign investors, called FRIPTA. And that rule taxes investors at a very high rate. And it causes, if you don't have a tax treaty with the United States, causes your income from real estate to be treated as ordinary income. And so when we have a French reinsurance company as a client, they came to us last after they did Asia, they did Europe, they did Africa before they came to the United States, because the penalties were so onerous as foreign owners. It doesn't make a lot of sense. We did it because we thought the Japanese were going to buy the real estate in the 80s. That didn't really happen. And they never changed the regulations. Real Estate Roundtable is trying to get that changed in Washington now.
Are there any bankers in the crowd? Your bank's being aggressive on the real estate side, trying to invest real estate dollars? Or?
I think our bank is not too aggressive at Boston Private Bank.